Welcome to the Wish IPO analysis. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information. Patreon.com/StockerFinance to support the show. So today we're going to be looking at the Form S-1 registration statement. This is with all IPOs that file this form through the Securities and Exchange Commission here in the United States. You may notice it says Context Logic Inc. That is a parent company for Wish. That is the name of it. But the company we're going to be analyzing, and what you may know it as, is called Wish. What they do is they sell very affordable and cheap products, so they actually directly order those products and they act as a middleman for the Chinese factories and manufacturers in China, and then they ship them over here in the US as well as some other countries. Because they're going directly to the manufacturers, they're able to sell these products at extremely cheap prices. You may have seen a lot of YouTube videos of people buying stuff on wish.com. They're usually kind of low quality, cheap items. It's basically a dollar store built into a platform. That pretty much sums up what this company does. It's going to be trading under the ticker symbol WISH, so Wish, super simple ticker symbol there on the NASDAQ exchange. It's a $1 billion placeholder right now, a potential $30 billion valuation. I suspect it'll be around there. I think this IPO is going to be very hyped up, just along with Airbnb and DoorDash as well. Maybe not as popular as those, but it's still a very popular and well-known company that we're going to see a lot of retail investors definitely investing in and checking out. But this is a super interesting company that operates with a really interesting business model. 100 plus countries right now, 500,000 plus merchants, 640 million items shipped, 100 million monthly active users, the #1 most downloaded shopping app, has 90% plus on mobile, $2.3 billion in LTM revenue, and 32% year-to-date 2020 year-over-year growth. Now, obviously, this is a website that sells very cheap items, extremely discounted prices, because it's going directly to the manufacturer and acting as a middleman. So during times like this, recession, people are struggling or maybe not doing as well in terms of their finances, they're going to want to buy cheap items. And the Christmas coming up, I think Wish is going to thrive in this economy. But can it actually be profitable? Well, let's find out here once we get to the numbers. First off, though, we're going to look at a little overview. I actually thought the story of Wish was kind of interesting, so I'm going to go ahead and read this part. If you're not interested or you want to read it for yourself, you can, or you can just skip forward a little bit. But let's go ahead and get into this. So we launched with Wish with a simple mission to bring an affordable and entertaining mobile shopping experience to billions of consumers around the world. Since our founding in 2010, our vision has been to unlock e-commerce for consumers and merchants by providing consumers access to a vast selection of affordable products and by providing merchants access to hundreds of millions of consumers globally. We have become one of the largest and fastest growing global e-commerce platforms, connecting more than 100 million monthly active users in over 100 countries to over 500,000 merchants, offering approximately 150 million items. Our platform combines technology and data science capabilities, an innovative and discovery-based mobile shopping experience, and comprehensive suite of indispensable merchant services, and a massive scale of users, merchants, and items. The combination has allowed us to become the most downloaded global shopping app for each of the last years, according to a report from Sensor Tower. We are focused on democratizing mobile e-commerce by making affordable and accessible to anyone. The global commerce market was $2.1 trillion in 2019 and is expected to more than double to reach $4.5 trillion by 2024. So in 4 years, it's expected to double. Actually, about 3 years now, it's expected to double to $4.5 trillion. Sorry, I can't talk right now, which is a massive market, which means there's a pretty large market opportunity for this company. Well, e-commerce grew from 3% of global e-commerce or global commerce in 2010 to 14% in 2019. E-commerce companies have largely focused on serving affluent customers by offering branded goods and prioritizing convenience over price. However, 44% of U.S. consumers and 85% of European consumers have a household income of less than $75,000 and cannot afford many of the traditional e-commerce offerings. Additionally, in the emerging economies of Africa, the Middle East, Latin America, and Eastern Europe, where the average household income is approximately $18,000, affordability will be a key element for users shopping online. We believe that the next billion e-commerce customers will be these value-conscious customers or consumers. According to a survey we concluded in 2020, across 2,850 consumers in select countries, approximately 75% of those responding prioritize the price of an item over brand and delivery time. We built Wish to serve these consumers who favor affordability over brand and convenience and are being underserved by traditional e-commerce platforms. We are revolutionizing mobile service, blah, 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 and entertaining. Over 90% of our users' activity and purchase occur on our mobile app. Our data science capabilities allow us to mirror how our consumers have shopped, et cetera, et cetera. Over 70% of sales on our platform did not involve a search query and instead come from personalized browsing Wish users. So anyways, there's a quick summary of what this company does. They have a huge market opportunity here. I really love that they're targeting people who are, especially during times like this, in a hard financial situation, or just simply aren't making as much money as other countries. If you live in maybe a more remote country, if you're living in the Middle East, in Latin America, etc., you probably aren't making as much as someone on average in the United States. So because of that, they can definitely appeal to that large market there. Other market opportunity here, they say billions of value conscious customers are undervalued. And I'm just going to quickly go through this. I don't want to bore you with too much more reading. Traditional e-commerce does not meet evolving consumer demand or behavior. And I kind of agree with this. I kind of disagree with this. I think there's a lot of cheap items that Amazon continues to lower and lower prices. Same with a lot of these large grocery stores. But Wish is on a, Wish has to, what consumers also have to understand, I think, is you can go get a cheap item on Amazon. And generally when I buy a cheap item from Amazon, the quality doesn't lower significantly. It might be a little lower quality than the branded item. But when you go to Wish, I've noticed that the quality of the items lowers significantly. You can really tell this is becoming straight from a manufacturer in China. And because of that, the quality lowers a little bit significantly, and there's been a lot of cases where people order something, it's not what they wanted, something entirely different, or it's just not that great of an item. So they definitely have some quality control that they need to handle. Amazon, I feel like, does a lot better job at quality control. However, it still has some issues with that as well. They say merchants lack technology-driven tools to operate their business. They lack access to global consumers. Continue on here. Their value proposition to Wish users: affordability, accessibility, it's everywhere. Mobile first, so they're really large. 90% of our users' activity was purchased occurred on the mobile app. Discovery-based, personalized, entertaining. And you can read through this more in detail if you want. It's just a lot of wishy-washy words saying why they want to support consumers and do this and that. We really want to just get to the numbers here in a second, though. They talk about user acquisition, lifetime value maximization, dynamic pricing. They talk about user personalization, so they want to personalize the app and recommend items that this user might be interested in based on their purchasing patterns. User generated content, merchant insights, product boost, logistics, user and merchant support as well. Just talking about how they're going to support their consumers, how they're going to market their product to consumers. Here's their growth strategy as well. They just kind of go on to expand, geographically, continue to acquire new users. They said that we are focused on growing our new user base around the world. We currently serve users in over 100 countries. We estimate that there are over 1 billion households with income of less than 75,000 around the world, excluding China and India. So some big markets that are excluding out of that. That's 1 billion households. That's a lot of money that could be spent through Wish. So a large opportunity there. They want to drive user conversion, drive profitable lifetime value from existing users. One thing I noticed they're not saying here is they're not talking about sustained profitability, because this company has a really issue with sustained profitability, like we see with a lot of these new IPOs lately and technology companies. So yeah, you can keep growing, you can get new users, you can acquire, you can spend money on marketing, expand, geographically to new countries, whatever it might be. But if you can actually make a profit, then your company is not going to work. And as an investor, I'm not going to look to invest in your company. Let's move on here, though. So to continue to innovate and extend their platform, they want to monetize brick and mortar stores. So we're still in the early stages of building out and monetizing their Wish local offering. We do not currently charge our Wish local stores any incremental traffic of revenue that could help bring to their store. As we continue to grow our Wish local program, we plan to explore different ways in which we can further enhance our value proposition and monetize our offering, whether in the form of additional traffic or sales to the store. I think brick and mortar is actually a pretty good way for this company to go, just to supplement the app. I'm not saying they need to only go and transition to brick and mortar. I think online for this company is the way it's going to be. It'll be the majority of their revenue for their entirety. But I do think having some brick and mortar stores, especially in some more remote countries, or maybe you don't have the best access to internet, it could definitely help this company out pretty significantly. So now let's get into the numbers. And this is the part that gets really interesting and what I love the most about these forms. Now, we first can look at revenue since 2017. This is year ended since 2017. They did $1.1 billion in revenue. They grew that to $1.9 billion in revenue by 2019. And now 2020, they've already done $1.7 billion, 9 months ended September 30th. So they're definitely going to surpass the revenue in 2019. So revenue is growing very nice. But on top of that, we're seeing cost of revenue grow along with that. And cost of revenue is really eating into a lot of their profits here. We see $205 billion cost of revenue in 2017. That's now grown to $605 million, sorry, not billion, $1 million in 2020. That's a pretty big problem. That's only 9 months ended September 30th. So the cost of revenue definitely needs to decrease somehow. I understand they're probably operating with very low profit margins, but it is what it is when you're ordering directly from China and then selling it for very affordable prices online to consumers. Total operating expenses also increased slightly, but not drastically. Increased from $1,043,000,000 to $1,602,000,000, which is actually down from 2018. That's good. It started to decrease, and now in 2020 we see total operating expenses 9 months ended September 30th of $1.262 billion. So it might surpass that in 2019. We'll see once they fully IPO and we get more financial details on the full year of 2020 and how they performed. If that operating expense can continue to decrease from 2019 and then from 2018 as well, that's going to be a much better trend for this company and something that I would feel more confident about potentially investing in this company if that's the case. Let's move on here. We're going to look at the 2015 graph. This goes all the way back to 2015. You can really see the revenue growth here, just immense revenue growth. That's great for this company. One thing I want to point out here as well, you can see sales and marketing drastically increased in 2018 and 2019. So they nearly doubled their sales and marketing costs there. So they really wanted to push this app out there, or not just the app, but the whole service out there, which personally I think right now is an awesome time to just go all in on sales and marketing. People are stuck at home. People are bored. They're going to do random just random purchases they're not really going to think about. It's really a time for Wish to thrive right now, especially since they offer such cheap and affordable products when people are in tough financial positions. Going into Christmas time, Wish should really become a household name, and right now I don't feel like it's a household name. So if they can become a household name just like Amazon is, they'll thrive, and they might be able to even raise prices slightly and increase their profit margins, since people will be so used and addicted to using their service. And we've seen this with lots of technology companies. They offer a really cheap service, they lose money, and they slowly raise prices because they get you hooked on that service, and that increases their bottom line and eventually leads to profitability. That's what Wish really needs to do. And then they start cutting some costs as well. They can slow down on marketing, and their profit margin will only increase from there. So hopefully that's the strategy they're taking. Obviously, I'm not talking to their CEO right now, but if I was him or her, that's exactly what I would do. General and administrative costs we see increase as well, but not drastically, not too much to worry about there. We're just looking at revenue and net loss here. You can tell that their net loss actually decreased pretty substantially. So it was $537 million in 2015. It decreased to $208 million in 2018, which is up from 2016 and 2017, but not too drastically. And then 2019, we see it decrease to $129 million. So that's awesome. They're improving significantly. Their margins are improving. But then in 2020, we see it increase 9 months ended right now to $176 million, which is significantly up from only $5 million in 2019. So kind of a bummer there. I'm not sure if they're spending a lot more money or what's going on. We can look at cost of revenue. It increased just drastically during 2020. So that's most likely the main reason for them not being as profitable and having a significantly greater net loss than in 2019 during the same period. If we go down to the bottom of this chart here, we can first look at cash and cash equivalents. Actually at the top, they have about $1.1 billion in cash and cash equivalents with $55 million in working capital, $1.42 billion in total assets. That's great there. So a lot of cash on hand. That's great for this company, with a stockholders deficit of $1.6 billion. And we'll look at that in a second here as well. Monthly active users. So those continues a really important statistic here, one that investors always pay hardcore attention to, especially the institutional investors. So a lot of the big banks, this is a statistic that they really pay attention to, because so many users are online right now. It's like, where are they spending your time? How many of them are using your platform? And monthly active users can kind of give you an insight into that. So we see it's increased significantly from 21 million to 90 million in 2019, now up to 108 million 9 months ended in 2020. That's awesome there. Great for this company. Definitely some of that was driven because of the pandemic we're in, but I think that hopefully they can sustain some of it and get people hooked on using this app. We see adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, has increased, has actually decreased their loss there, which is awesome over the past few years. However, we did see a slight increase from the 9 months ended in 2019 to 2020. Again, though, we already kind of talked about why that's the case, with an increase in with an increase in cost of revenue, as you saw back there. Free cash flow actually was positive for quite a while in 2018, then 2017. Something happened in 2018, not exactly sure, but they went to a negative 114 million in free cash flow down to a negative 71 million in 2019. Now they have positive cash flow of 23 million in 2020. Free cash flow is really all over the place right there. They're probably acquiring, spending lots of money, and that's the reason for so much volatility in free cash flow over the years. If we move on here to the next thing, we can really, this is one of the big red flags actually that I've noticed. So first off, we'll start with the good thing. Cash and cash equivalents from 2015 to 2019 has increased significantly, even to 2020, now with $1.101 billion in cash and cash equivalents. That's up from 359 million in 2015, and that's up from 2019 of 1,078,000,000. So significant increase in cash and cash equivalents. That's awesome. Working capital has also seen a slight increase from 2015, but a decrease from 2018, 2017. And then 2018, 2019, it was the same, and then a decrease to 55 million as of September 30th, 2020. Total assets are increasing slower than total liabilities, and that's why we're seeing this total stockholders deficit increase over time. This is a big red flag. As an investor, you don't want the stockholders deficit to be increasing this drastically over time. They really need to reverse this trend. Whether they're taking on too much debt, whatever's going on behind the scenes here, and I'm sure if we had some more information, we could figure it out and get into the nit and grit of this company even more. So hopefully the first quarterly report will give us that. But the total stockholders deficit increased from 692 million in 2015. Then in 2019, it's 1.4 billion. And now it increased as of September 30th, 2020. The year's not even up yet, to $1.6 billion. So they really need to reverse that trend. That's not healthy for this company. Free cash flow, we already touched on that. Now let's move on to the merchant platform expansion. These are just some simple graphs they gave us to give us an idea of this company. It shows how their kind of their strategy for growing their platform, user platform expansion at 100 million plus users, monthly active users. That's great. Lifetime value per buyer by cohort. That's the person who just made this graph, I believe. So lifetime value here though, increase in 2018, and you can just kind of take a look at this chart. It's really interesting, but not too much to look at here. A lot of that financial data already gave us this. This is just an easier way to visualize it. LTM revenue and new and existing buyers in billions. So revenue from existing buyers has increased to 69%. Revenue from new buyers is at 31% of total revenue. If we move here, we can look at average revenue per average buyer. So that's increased over time as well, which is awesome. And then we can look at core marketplace revenue. So in Q1 2020, they did 340 million. In Q2 2020, 555 million. Q3 2020, 405 million there. That is a increase of 67% and 17% respectively, but Q1 2020, a decrease in 8%. If we move down here, we can look at cost of revenue. So that's we already kind of touched on this a little bit, but gross margin is a part that we haven't touched on as much. That was 81% in 2019. It decreased to 67% in 2020. Definitely something they need to work on there. We can look at purchase obligations, operating lease obligations. Not too much to touch on here. They do have some purchase obligations of 129 million and 58 million in operating lease obligations, with the total contractual obligations of 167 million. But again, they have over $1.1 billion in cash. Not too much to worry about there. Now we can break it down by Europe, North America, South America, and other. And as you can tell, Europe and North America pretty much dominate Wish's platform, which I actually think is a good thing for investors that are looking into the long term. The reason I say this is because China, India, the Middle East, those have huge populations. Africa as well. They have huge populations and a relatively low average income compared to North America and Europe. South America is on there as well, and it's a fraction of the percentage compared to Europe and North America. So they're going to expand into Africa, the Middle East, India, maybe China itself, as well as continue to go into South America. They're going to thrive and be able to have a much, much, much larger customer base because the populations are so massive in those areas. In fact, they're multiples higher than the populations of North America and Europe. Even if their income is lower, Wish offers very low margin and low income items. It just needs to get that cost of revenue slightly down, cut some costs as much as it can so that it can maintain profitability. So to summarize this company in this IPO analysis, revenue is growing. That's great. That's why I highlighted it in green here. Lots of potential. The brick and mortar stores, I like that. Expansion to other countries, lots of room for expansion. The potential market size and the opportunity for this company is massive. They just need to lower their cost of revenue, and they need to find out how to create sustained profitability. If a company will never be profitable, why would I want to invest in it? There's very little incentive as an investor, institutionally and for retail investors, to invest in a company that is not profitable. So they need to figure out how to sustain profitability in the future. Stockholders' deficit is increasing. They need to reverse this trend. Again, that really has to go with either lowering debt, more cost cutting, etc., or simply getting users hooked on the platform and then slowly increasing prices. I'm not saying they have to add $10 onto each product, but just 25 cents here and there. That'll make a big difference in their bottom line. So just slowly increase profits, even just if they're increasing the cost of the items by cents, it'll make a big difference in their bottom line there and their margins. More sales and marketing right now. I think this is an awesome time to just make Wish a household name. China relations may better, which will help the outlook for this company. Interest in this company, or I'm personally interested in this company, but they need to fix some things before I'm confident. I've already touched on that. Anyways, guys, I really hope you enjoyed. Thanks for watching. Please subscribe. Check out my Twitter at StockerFinance. I post updates on videos, as well as some other my take on the financial industry and other things like that. Make sure to check out these videos here, patreon.com/StockerFinance for some more information, and if you want to support this channel. Anyways, I'll see you guys in the next video. Peace out.